What is policy lifecycle? Policy lifecycle represents the complete journey of an insurance policy from the moment a customer first applies the policy, expires, or it is renewed. So policy lifecycle encompasses every interaction from initial application through claim settlement and policy continuation. So in short, the complete journey from issuing the policy to the claim settlement and finally to the renewal of the policy. So the complete journey is called policy life cycle. There are 7 stages in the life cycle. First is generating the policy proposal. Then it is underwriting, policy issuance, premium payment, policy servicing, that is changing any address or updates or nominee modifications, claims, where the customer file claim when unfortunate event occurs and receive the payout, and finally the policy renewal. So let's take an example to understand it better. For in health insurance, a client applies for health insurance, then the underwriter will evaluate whether the policyholder is a right fit for this policy or not. So if everything goes well, then the policy would be issued and customer would pay the premium. And in case of unfortunate event, a client will file up the claim, and then if everything goes well, then probably the client can renew the policy. What are riders in insurance? Riders are optional add-ons attached to a base insurance policy that provides additional coverage for specific situations or enhanced benefits. They allow customers to customize their coverage without purchasing separate policies, making insurance more flexible and personalized. So riders are beneficial for the policyholders as well as for the insurance company. So for the policyholders, they do not need to buy two policies. They can probably add on the rider with them, which would decrease the cost as well. If they have bought two policy, and if they have bought one policy and added a rider, then it have costed less to a policyholder. Whereas for an insurance company, they are able to cross sell their services. So it is beneficial in both the cases. Riders help insurers offer personalized products while increasing revenue through cross-selling and upselling opportunities. So example could be critical illness rider, where the lump sum or the sum assured payment would be provided to the policyholder if they are diagnosed with critical diseases like cancer, heart attack, or stroke. Accidental death rider, where the additional payout amount would be provided to the client if the death occurs due to accident. So benefits of a rider are increased coverage, cost effective, and they can be personalized as well. What is insurance fraud? Insurance fraud occurs when individuals intentionally provide false information or exaggerate claims to receive money from insurers unfairly. This deliberate misuse of insurance system undermines trust and increase cost for everyone. In short, submitting false documents or illegal documents to get the sum insured amount from the insurance company is called insurance fraud. Insurance fraud is a major risk for insurers, and detection today relies on rules engine, data analytics, and AI models to identify suspicious patterns. So examples could be fake hospitalization bills, exaggerated damage such as overstating extent of vehicle damage or property loss to receive higher settlement amounts, false claims, filing claim for loss or incident that never actually occurred. So why fraud detection matters? It impacts all the customers. It increases premiums for all honest customers, making insurance less affordable and accessible. Financial losses causes significant financial losses to insurers, affecting profitability and solvency ratio. System trust undermines trust in the entire insurance system, making customers skeptical of legitimate claims.